while you have to be extremely careful in this market, I think there will be also some good opportunities, but I can't talk about it short term. In the short term, I think you may have some big downdrafts.
That was activist investor Carl Icahn talking to us on Friday exclusively about his investments in the current market environment. So here with her take is Kathryn Rooney Vera, Baltic head of research and strategy. Kathryn, you tend to be more constructive and take on more risk in markets where people don't like it. What are you doing now?
Yeah, now I tend to agree, Alex, with Mr. Icahn. I think that there are going to be downdrafts precipitated by horrific data from the economic side, which the market, with its recent, 30% bottom to current pricing, is not discounting. Uncertainty, default, a second bout of virus, I think, could also be another thing to precipitate that downdraft. And thirdly, of course, a terrible earnings. So I think that the market is ahead of itself based on bailouts, stimulus, a crowding out of the private sector, as Mohammed Al-Arian called it, moral hazard. And I don't buy into it.
So I guess the question is why? Because you can make the argument that if you're looking at a V-shaped recovery within the equity market, they're going to be forward-looking. Maybe they're pricing in that kind of recovery on the economic front. What's the counter to that?
Well, 2021 is, of course, going to be a tremendous year in terms of economic bounce. But this year is going to be the worst that we've seen since, of course, the Great Depression. And the longer, Alex, that the economy remains closed, of course, the worse that will be. And we could be facing a depression rather than as what I think the market has priced in, because it's currently not pricing in, but did price in that 2-week slide, is a traditional recession. The fact is that the economy is closed, right? The economy is still closed. In a consumer-based economy, 3/4 of the economy based on services, and the consumption of those services are closed. The consumption is closed for business, and there's really no clear path to the resumption of normal habits of consumption. The president and the administration could say we're going to phase in a reopening, but Alex, you and I know that, and we've seen it in the case of Germany, that once they allow restaurants to be opened, maybe some people will rush in, but others will take a step back and say, you know what, I'm going to wait until there's at least some medical remedy or some vaccine so that I can assure myself that when I bring this along to my 70 or 80-year-old parents.
It's a really good point. I do wonder, though, what has to be on the shopping list once you wind up getting some kind of clarity, because tech, for example, market breadth is just really petering out, and tech has led on the upside. Tech hasn't sold off that much on the downside. So some of that's already obviously baked in. So how do you even know what your shopping list needs to even look like?
I think you need to look at the broad S&P. The S&P is currently overvalued, as your previous guest said, and I agree with that. The market has priced in a V-shaped recovery, and I think a recovery that's going to be worse than what the market is currently expecting. So what you have to be, I think, focused on is, as you mentioned, tech. Once you get that downdraft, as Mr. Icahn calls it, you do want to buy tech. You want to buy tech. You want to buy staples. This is a recession, the likes of which we haven't seen since the Great Depression. So I think you do want to be positioned in those defensive names. And I'll add to that tech, because this is, of course, the next industrial revolution on steroids, and tech is certainly what is going to take us into future paths of productivity and efficiency, and I think that's where we need to be. But the fact is that one can't discount another correction in the offing, and I think that's going to be coming over the course of the next couple of months. And Alex, one final point, for those of the clients that I talk to that are listening right now, this FOMO, this fear of missing out that I'm hearing everywhere, I would caution those investors not to chase maybe a premature rally that doesn't have legs for the sustainable, next year. I think that you're going to see opportunities sent to the market. I think you're going to want to take those opportunities, because if 2Q drops 40% quarter on quarter, seasonally adjusted, Alex, you're going to get, even because of base effects, you're going to get phenomenal jumps in 2021 in terms of economic growth.
Right, it's going to be super distorted, though, to that point. So then what do you wind up doing with emerging markets? We've been talking about Brazil kind of all morning. What do you do there?
I think if you are an investor that has a multi-year horizon, that you do want to be looking at Brazil in terms of buying positions in names like Brazil and even the MSCI Emerging Markets Index over the course of the next couple of months, because as I mentioned, if you do see that risk-off movement, you're going to see another leg down in the real, which is massively undervalued right now at what, 5.5 to the dollar, something to that effect. So I think Brazil is well positioned to outperform generally in emerging markets once we get that stability and that bounce that comes from a resumption fundamentally, and not just based on base effects, Alex, fundamentally from a resumption in the main drivers of both the U.S. and global economy, which is effectively the consumer.
So what's the pain trade now to equities?
Look, I think you're going to be seeing some nastiness with regard to correction in terms of the broader markets. So what I'm telling my clients is, and I know everyone's talking about cash being king, but I say keep your powder dry, because there's going to be opportunities to enter the broader markets, and especially, as I mentioned, I like financials, I like defensive, and I like tech. Those are the sectors that I most like. And I would say keep that powder dry. Look, don't be scared that you're missing out on the last opportunity, and maintain that cash position to be able to, buy into the market once you do see that additional 10, 15, even 20% downside.
All right, Kathryn, really appreciate that. Sort of the warning against FOMO. Thank you, Kathryn Rooney Vera of Bull Tick. Great to catch up with you.